Welcome to live Q&A from NewDeal Invest. I already outed myself that I'm actually sick, so you'll be hearing a lot of funny things from my voice during this session here. And with me today is my computer expert, Jesper.
Hey guys, hope you're doing well and tuning in. But yeah, we are going
And
live
yeah,
for the
I
second
just
time.
got the noise out of my ears. So yeah, program for today, we're going to just briefly recap a little bit about ourselves here, because this is the first time we do it in English. And then we're going to follow up on some of the questions that we didn't manage to get to last time. We got some positive feedback, and the negative feedback was that we talked about too much about subjects that we wanted to talk about ourselves instead of answering the goddamn questions that was asked. So we'll make up for that this time and focus on the questions. And there are some questions on C Limited, on quantum computing, on Tesla, on HelloFresh Group, and on the PMI and the I. So do write questions in over at YouTube, and we'll try to see if we can get to as much as possible. Jesper, will you say a few words about yourself?
Yeah, sounds good. So my name is Jesper, and I work at NewDeal Invest as a UX designer. That's sort of the field I'm trained in, although I also have a few years of experience in the gaming industry, also on design work, but a little bit broader. I've been working with virtual reality and augmented reality for a number of years. And on top of that, I have been a private investor or investor on my own time for the past 10 years or so. And I run an investment blog online called jesperbæk.com, where I share my thoughts on my own positions, thankfully very similar to all the ones in the NDI portfolio. So that makes things a lot easier. And yeah, we're here to answer all and any questions that you have today related to investing. Mess, do you want to share a little introduction about you
Yeah.
and NDI?
Yeah, I'm Mads Christiansen. I'm the founder and CEO of NewDeal Invest, an investment fund started at the top of the market in 2021. So we invest in tech stocks only. So we had quite a slide down, has been learning a lot, and I actually think it will turn out to be a really good start, not for the initial investors, but for the rest of the long trajectory that we're going to have in NewDeal Invest. We are a I'll just see if I can share the screen here.
Yeah, looks right to me.
That was not the one.
Oh, okay. Wrong screen.
So
But
I invest in tech, but I'm not really good at tech. Yeah, so here's the one. So NewDeal Invest is a tech investment company, and we have a new process, and we do the investing process by. We'll get into some of it today, and follow us, and you'll get familiar with what we're trying to accomplish. We've got what we call layer 1 and 2, and that's our core. And then now we have 3 different distribution channels. We have the original unlisted main fund, which is you need to invest 100,000 euro as minimum. That's regulatory. And then we have the public listed fund, which you can buy in your web bank. It's listed on the Nasdaq in Copenhagen. And ticker is PMI and the I. And the ISIN code is this here. It can be traded in some countries outside of Denmark, but it's something that we need to work on down the line to get that done. I just need to see if I can like that. Okay, and then we've got the latest thing here, which is our eToro NDI Future Tech portfolio, which just launched for investors here in 2 weeks ago. And we just had the opening event with eToro. We rented the old Danish stock exchange and had a lot of friends and investors come along and hear some presentations from us and eToro and some of the eToro star investors. And it was a magnificent day and yeah, such a great milestone for the company to be in. So now we can be traded around the world wherever the eToro platform is.
Yeah, and I think it's important also to notice that our public listed fund, only came live in what is it, October last year. So that hasn't had that long of a run either. But the eToro fund is brand new. So
Yeah, exactly. So I'm struggling here, Jesper. What's the next thing we're going to talk about? I
uh,
have so many windows open.
sorry.
I
Well,
just
I guess we'll
too
just
good.
jump into some questions from last time, actually, assuming we can handle it right now. So the first one that we didn't get to from last week is from Nils, who asked, "What's your take, Mads, on C Limited's future?" And yeah, given that it's up in the short term, but still down in the dumps as over the for the last few years.
Yeah. Yeah, let me try to explain what I think. First of all, I wanted to look back actually and show you what happened to Amazon. This is on Coifin, and the orange line, the thin line, is the gross profit of Amazon back from year 2000 and then to present day, and the other one is the stock price. And what you see is that there is a correlation. What's really driving the stock price is the gross profit when it's increasing. Amazon is a growth company. They invest everything they earn in future growth. So they don't have a bottom line that's worth talking about, but they keep building new business models and thus creates value for shareholders. So what we see then is that we look at, let me see if I can make this a little bit more easy to see. Yeah, let me see.
I think that's fine.
Yeah. So what we see here is that we have some drawdowns, and this is a logarithmic scale. So share price, dang, yeah. So yeah, here you go. Share price from the bottom here and up to the normal correlation is from its market cap. So it's from 25 million in market cap in September 2001, and then up to 405 million in market cap. So that's more than a 10x over 2 years because the correlation went, it was just flushed out compared to where its gross profit was. And then if we go further to the great financial crisis, we'll see that the market cap went down to 250 million, and then when it caught back to the correlation with the gross profit, we were at 1.24 billion. That's a 5x increase. And we see that again here. So what we see is each time we have a general big correction, we see tech stocks being flushed out. And yeah, I could do Salesforce here, which should show the same pattern. Here you go. And if I do 20 years here, we'll be able to see here we have, now we need to do more here. So this is Salesforce, and I just wanted to show you the great financial crisis. Here you have it again, once again, with Salesforce down to 38 million, and then all the way up to 294 million. So again, sort of a 10x increase in market cap, and just due to an overcorrection by the markets. So our general thesis is that growth stocks are actually normally priced, and then they fall out of the bed every once in a while. And then let's go over to C Limited to see what has happened here. And here we see the same pattern. We see the gross profit increasing, and then we see the share price just plummeting through. We see maybe it was a little bit overvalued, but now it's definitely undervalued compared to the gross profit. So that's what I think is happening to a lot of the small growth stocks right now. They're just being undervalued right now because the market goes to safety when things get tough. So let's look at C Limited and let's look at how to look at their earnings report, because I think the market gets it very wrong. So what the market typically sees when they look at C Limited, they see a company with a revenue of 3.6 billion growing 5%. So if you dig a little bit into that, then the real important part of C Limited is the e-commerce part. And you have the total revenue of e-commerce, 2.6 million, growing 23.2%. But that revenue is divided into these two here: core marketplace revenue and value-added services. Now, core marketplace revenue, that's the fees and that's the advertising dollars that they earn. Value-added services, that's actually their logistics services. And let's take value-added services first. It's declining 5.3% year over year. And you might think that's weak, but actually that's very strong. It's because they're able to lower prices on fulfillment for customers because they are getting to scale. And also because a lot of the marketing efforts from C Limited is free shipping on your first orders, and that takes down the value-added services. When they market, try to acquire customers, it's because they see benefits, they see an opportunity in the market. And then you have the core marketplace revenue, which is up 40.6%. So the core business here, what we want to see growing, is actually growing 41% to 1.6 billion. So this core marketplace revenue is what I want from C Limited. It's high margin. It's actually software as a service. And then the next thing I like about C Limited is their digital financial services. It's such a big part of an e-commerce ecosystem. You have their loan lending business, which helps small marketeers on their marketplace get loans which they could not have gotten otherwise to ramp up their businesses, and C-Money has good data on them. You get buy now, pay later, which customers love and sellers love it. It's helping facilitate trade, and you get the data from that. You have a digital wallet, which decreases transaction costs for sellers and buyers on their platform. So digital financial services is such a powerful amplifier for their entire business. And it's also a really good cash cow. We see Mercado Pago out of from Mercado Libre really has been a big part of the growth of Mercado Libre for the past couple of years of both their top line and bottom line. And we have digital financial services growing at 24% here. So what I do when I look at C Limited is I say, this revenue here is interesting, and this revenue here is interesting. And that adds up to about 2.1 billion for this quarter, which is growing about 40% on all. And yeah, and that's out of the 3.6 billion. So somewhat more than half of the revenue is really high quality, high growth. And what do you have the rest of the company? You have the Garena, the gaming business, which is earning about 500 million in EBITDA a quarter. That's quite good. No, that's revenue. And EBITDA is 217. So yeah, you say that digital entertainment is about a billion in EBITDA a year, and that's quite nice for a competitor in e-commerce to have. And you could value that at something. But if you just say, we're just going to look at the core business, we've got 2.1 billion growing at 40%, and then try do an evaluation of that. Then we have the market cap here of Sea Limited, which is 33 billion now. And you had 2.1 billion per quarter. That's 8.4 billion annualized. So that gives you an enterprise value to sales about 4 for a high margin, high growth, a very attractive business, a dominant e-commerce player in the market. So I think that if you just do the math of just disregarding the gaming business, disregarding the logistics, then you have a very attractive price on the core, which should give ample room to grow. So in this case, in Sea Limited, I simply think the market is getting it wrong, dead wrong, because they are leading and they are taking market share out there. And yeah, the market just lost perception of the numbers and how to digest the numbers. So I think Sea Limited is such a no-brainer at this point. A really good stock to own for the long term.
Yeah, and when you see, revenue numbers up, like, what is it, 4.8% or something for the quarter, that whole thing is really, obscured by the large gaming legacy business. Like, it doesn't give any credit to the new businesses that are just starting up and growing really rapidly, right?
Yeah. And once you look at a gaming company and you look at GAAP numbers, then you get a number that is deferred revenue. So usually people analyzing gaming companies, they want to look at bookings and adjusted EBITDA numbers. But if now people are looking at GAAP numbers, and then the Garena numbers are just obscuring the total numbers of the entire group. So that's really what's obscuring things and making it kind of hard to understand. But you should not look at it on a consolidated level. That's wrong.
Yeah. All right. Remember, guys, remember to ask questions. You can see Mads, it does a lot of effort here going through all the things, even though this was a little pre-prepared from last week. But we'll go over to the next question here, which is from Hjalte, who asked, how do you balance the need for detailed stock analysis and coverage of individual stocks?
Yeah, so it's a really good question, and I'm so glad I got some time to prepare, because I was sitting and looking at it and thinking, how do I explain this? And then I just want to show you an old hero of mine, which is Rory Sutherland here. And he has this, he talks about how the world is so hard to predict. And then he talks about a concept he calls maps of the world. So when you're making a map, you're taking an extract from reality, and then you want that map to be able to show you what you need to know about reality. So if you're driving a car, you want the roads in the map. If you're flying an airplane, you don't really care about the roads, but you want the air corridors and you want the airports. And if you're hiking, you want to know where the bears are, and you want to know where the shelters are and the path that you can walk on. So the thing that you take out from reality to make your little model, that really depends on what you're trying to achieve. And some models are good for something, and some models don't work for other things. And I actually think that the answer starts there, because detailed stock analysis is really the way we usually do it in stock analysis is good when things are predictable. So when you can predict how things are going to pan out in a couple of years, then the classic stock analysis process is very good. But once you get into tech stocks, where new companies are emerging, new technologies, new sort of everything, governments has something to say about what companies win or not, then it's not so deterministic anymore. Then it becomes more probabilistic, it becomes more complex, and you sometimes get surprised. And that's what Rory Sutherland calls magic. It's when something you never thought would happen just happened. Like when TikTok emerged, who could ever had imagined that would be so powerful to be able to predict which small video you wanted to see. So you get these products and new ways of attacking things that are just smash hits, and they disrupt everything. So when you're moving at the forefront of technology, you cannot predict things. So so you actually need a new model, and that's what we are trying to do with our two-layer model. So a little bit more context, then I think short term, less than 2 years, it's a game by itself. You have alternative data, you have AI, you have lots of compute, you have people knowing stuff that you don't know, you have rumors, whisperings, you need to know something about politics, and we could never ever have an edge there as a small boutique fund manager. So it would be a giant mistake trying to compete in that game. But if you think long term, then all these efforts from companies buying alternative data and all of that, it looks a little bit like a waste of effort, and that's where we're trying to be, trying to learn about technology and hear all the companies, hear what the founders are saying, where they think the world is going, and then we're not trying to hit it, but we're trying to aim in the right direction and aim at several shots, and that way we really do a lot of good on the variance that really hurts portfolios on the long term within tech investment. So yeah, that's a long answer that I don't think it's a good question, but it's not. I think the answer is that the model is not right for tech investment. The classic deep dive stock analysis is, I wouldn't say waste of time, but you don't get a lot of value from the last 50% of the analysis you do. Maybe it's better to read a book about quantum computing or something like that.
Yeah, and I mean, especially for tech companies, right? One little thing can sort of make future predictions of revenue or something off by, power of 10, just from one little number changing because the margins are so high. So in our business, particularly, it's even more difficult to rely on analysis in the sort of long term, right?
Yeah, exactly. I'll just take a trading view up here. So and just show a couple of examples. I actually had something planned here. So let's see how they're doing, the guys that are really doing deep dive stock analysis. So this is PMI and this is Nasdaq since the beginning, and then let's look at Carvana. Yeah, so it's up in just 3 months. It's up 150%, something like that. So deep dive stock analysis didn't do well there. Fastly here, down 80% or something. No, not 80, but down a lot. Let's say that. We can do Snowflake here, And Snowflake, yeah, they lowballed their earnings or their guidance for next year, maybe because of the new CEO to give him an easy start. But still market got it quite wrong compared to what they delivered. HelloFresh is just a mess, at least from what the market is thinking. We'll get back to that. And then we have Cardlytics here, which is going down and then going up a lot here. Rose 77% on Friday. So my point here is that if this is what we're supposed to be doing, deep dive stock analysis, then Mr. Market is not doing a very good job on it, because wow, things are all around the place. We got GitLab as well, getting up too high, and even Nvidia has not been something that the market has had an easy time sort of finding out where's the price going to be. So I think that Nvidia is actually a great example of that as well. So you need to be more directional than trying to be accurate.
Yeah, that makes a lot of sense. I don't know if you want a little pause from the strain on your voice, so I can answer a question in the meantime.
Yeah. Tell us about Tesla. There was a Tesla question.
So
Massey asked, "Hi Jesper, you're overweight Tesla. What has to happen for it to move? And do you have a guess as to when?" And you've been investing in Tesla for a long time, Jesper, right?
yeah, I'm a long time Tesla investor, and that's also the same. It's the same reason that it makes up such a large part of my portfolio. I first invested in them back in 2016, and then as I was watching the Cybertruck unveil in 2019, I saw the stock price sort of, just crash as Elon smashed the two windows they were trying to demo to be bulletproof. And so I bought in again another time in 2019, which was, a month or two before the big jump, and that's why I've been so happy with the stock. I really got to double down at the right moment. But we're definitely going through a sort of tough time right now in the whole space, the whole EV sector. And I think Tesla's approach has been to lower prices on their vehicles as interest rates have gone up, because every time rates go up, the car loans become more expensive, and that given that a car is already an expensive purchase for most people, that really puts a strain on demand. So the thing is, the strategy has worked. They still have the demand, but now it comes at a cost. It comes at a cost to the margins. And I think they chose the strategy because Tesla is uniquely positioned as the only profitable EV maker, or at least they were at the time when they sort of made this decision. And they also uniquely, for a car company, don't have any debt to speak of at all. And it's definitely a tough strategy to follow. It has a cost very clearly, but I do think they will eventually come out on top. And I think the truth of the matter is that even though it's putting a lot of strain on Tesla as of now, and Tesla or like the stock in particular, it's putting a lot more pressure on everyone else in the space, and we're already seeing sort of the first victims of that, with all the Chinese EV maker stocks down way more than Tesla, and then of course we have a possible bankruptcy with Fisker, the other EV startup soon. So, given how much the stock is down, it's currently the worst performing stock of the Nasdaq year to date. There's obviously a good chance that 2024 won't be a favorable year for the stock, but I just can't imagine that the story won't change once we start seeing rates go down again. And I mean, the price drops on the cars, I believe, may also have sort of bottomed, because we're at least seeing now that prices on the Model Y are coming up a little bit, and I think actually Friday Tesla just announced another 2,000 euro increase on the Model Y coming April. So I'm pretty confident that that's the direction we're going to see coming as interest rates start coming back down. Yeah.
Yeah, I totally agree. I just wanted to give an analogy from history here. The
Yeah.
picture on the you see here, the car is called Corona, and it's the car that that Toyota entered the American car market with. Yeah, it doesn't look fancy, but it wasn't. It was a low tier car, and they were moving in from the low end of the market, and but they were enabling a lot of Americans to have a car suddenly because you could buy a cheap Japanese car.
Yeah.
And what happened is that the American car producers, they said, "Oh wow, let them have that. That's low profit, low margin. It ties a lot of working capital. We don't want it. They can have it." So they sold a lot of Coronas, and then then they came out with the Carina, which was actually my first car, and the Carina was not a fancy car. It was not a really it was a low tier car, but it was a little bit better than Corona. And and once again, the American car makers, they say, no, well, that's low margin, it's high competition. Let the Japanese take that. We don't. And so they moved up. They made the Avensis, they made the Prius, they made the RAV, and eventually they had disrupted everything from bottom up. And because they had scale, they were able to produce at way lower prices than the American car makers were per unit. So they were just conquering the American car market that way. And it's actually the same tactics that Elon Musk is applying to with Tesla here. He's just better at producing cars. He's producing them cheaper because his production is digitalized from end to end. He's got a digital twin of everything that's happening, so he can alter production processes within days or maybe even hours. So he can save a penny here, a penny there, and that's just a huge competitive advantage. So it's not, in my opinion, at least, it's not about cars. It's about car production, and there is no one like Tesla on car production, and that's what's going to win,
I
in
definitely
my
agree
opinion.
on that. It's it's about the machine that builds the machine, right? He keeps saying that.
Yeah, yeah,
And for all that matters, I don't care what form factor a Tesla battery comes in. If it's a car, great. If it's a stationary project, that's great too. I mean, I put Tesla in sort of the energy sector in my portfolio officially, and I do that because, yeah, for me, it's a new sort of, it's a new renewable resource, being able to utilize batteries for this either, for whatever purpose it is, and I don't really care how they pump them out or in what form factor, as long as it comes out in an efficient way, with a margin, right?
exactly. I actually have a sort of yeah. When Apple stopped producing, stopped trying to develop EVs,
Hmm.
I got a thought that Apple has always been about designing, and now Musk has changed the car industry to being not about designing, but about producing. So I think Apple should have realized this long ago that this is not a competitive race of designing. It's about producing, and they don't stand a chance against Elon Musk on that. So they stopped. And then I think if you think that thought to end, then you could think that Tesla could be like TSMC
Mm.
for chips, where Tesla is just the foundry for EVs. And then you can have Apple designing EVs, and you can have Amazon and whatever tech company just designing the EVs. The sort of the physics will be the same, but the colors or the light show or
Yeah.
the games inside will differ. So then it will be design. But
And the funny thing is that, their supplier, Apple's supplier, Foxconn, has actually taken that path. They're building EVs for other companies now, on top of all the
yeah,
iPhones or whatever else they're producing. So they get it. But I mean, I guess when you're not in the production game, it's a big turn to make, and I just don't think Apple is going to do that. So in a way, it makes a lot of sense for them to jump out now and sort of wave the white flag, because it's probably not going to work out anyway, as the as how the sort of whole sector is moving towards now.
yeah. If I
Um,
talk a little about quantum computing, can you check if there are some questions
yeah,
coming in
there's definitely
to
already a lot of questions I have. So
yeah.
yeah, someone
I'll go
last,
really short on quantum then.
yeah.
I was at a short at a convention with the Danish officials and the Danish industry and the academia of Denmark about the chips efforts in Denmark, and that was quite interesting. And in Denmark on quantum, we have the Novo Nordisk Foundation that has a quantum computing program, and they are trying to they're trying to achieve something they call the quantum foundry of Copenhagen, and they say we are the leaders. They also say it's going to be insanely expensive to build actually a fab of quantum computing. So I'm very skeptical it's going to be in Denmark that we achieve that. But here's the timeline provided by the presenter from Quantum Foundry about quantum computing. So we are at the very early stages, and then we need to be able to demonstrate some hardware that actually works, and then we have to get something like instruction set architecture layer. We need the software that works on the quantum computing units, and it needs to be developed, and then we need to develop software as well. So it's quite far out before we are going to see some meaningful competition from quantum computing.
Yeah, and I think my stance on it is that it's definitely gonna happen. I just have no clue why or how. I do have of why, but I don't know when or who's it gonna be. I
Yeah.
mean, IBM is really big on it. I think there's a few Canadian companies. Uh, and generally, I actually think colder countries may have a better chance because it requires so much cooling. Uh, like with all the sort of Bitcoin mining going on in Iceland and stuff. But it's just such a far out thing. I have no idea how to predict who will actually end up on top as of now. So I'm staying out of it, but it's really interesting and probably very definitely going to change the world in some way. Um, but Mads, we do have a lot of questions. We have the first one here from Lucas, who asks if we have any thoughts on Lemonade and their stock price development. I don't remember if we keep that one in our portfolios. I'm not that familiar with it.
Yeah, we got small positions in Lemonade, which is an insurance company trying to leverage AI in getting better individual prices for insurances, finding other means than just your postal number, and sort of a very unprecise metrics to predict your risk and the price you're going to pay for insurances. We also got Root, which has been quite a funny experience here recently, up an insane amount in the past weeks since their earning. So yeah, yeah, it's not deep insight. It's not high conviction. I think it's what I talk about when it's that direction. and we have small positions, and we have positions small enough to add when they are falling, and large enough to take a little bit of profit when they're rising, because they are very volatile.
Yeah. All right. I'm actually not familiar enough to give any sort of input on it. But that's all right. We have a question from Ernest. It says, thanks for the Q&A, Mads and team. When would you sell a stock in the two-layer model? How lenient will you be for how long with results before you say it's not going the way that I thought it would?
Yeah, it's mostly about the and hi Ernest, it's good to see you here. Thanks for tuning in. Lovely. Yeah, so it's the stocks that we have in our portfolio are stocks where we believe they have a good long-term long-term they're going to have a good long-term journey, or they have a good chance of that, and have a good risk-reward profile, and that's based on their technology, on their financial situation, on their competitive situation. Simon He from Convexity is so sharp on the non-listed stocks that are competing with the listed stocks that we invest in. So we use that to figure out how certain are we of the long-term prospects of the company, and as long as that is intact, then we have the position. And if we get more uncertain on that, then we seek to exit the position. So the last stock where I decided we needed to exit was Teladoc after this earnings call. They have a telemedicine product, but they can't seem to grow. So either they don't have a sales team, or their product is not really that good, or it shows that much value for consumers. So it's going out. Then there was a stock like Cardlytics here, which is a small company that has some financial issues, but really have a great risk-reward profile. There we have a very small position, because that creates a lot of variance when the financial profile is risky. What happened in this quarter, because when they got into the earnings, it was actually one of our largest positions. And what happened was that in February they got Starbucks back, and that was sort of a clear sign that their product was getting better, because Starbucks quit about 1.5 years ago, and them coming back was a tell sign that product was getting better. They've been redoing their app, their product. So and what they need to get out of their financial hole is growth. So it looked like growth would be coming in, and I think it's a very interesting company right now, but also a very small company with quite a lot of risk as well.
Adam actually asks if you've got a price target for Cardlytics. I know we're probably not going to provide a very precise answer for that, but maybe you could just give some guidance on it.
Yeah, it's related to how digital advertising is going to fare. So what they have right now is they incorporate themselves in the bank's apps. So when customers of Bank of America, they look at their account in their mobile phone, they will be presented some personalized offers from Cardlytics, and so they share the credit card data from the bank in a data secure way, and that's really important for the banks. They need a partner that they trust, and they know Cardlytics, and they trust Cardlytics. Cardlytics has some of the major banks, so it's a barrier to entry for newcomers in. So what I think determines the long-term risk is how high is this ROI on these ads in banks going to be, and that really it depends on how much time are people going to be spending in bank apps in the future. Is there going to be something else that makes them not be in a bank app, or or is there going to be better ROI on advertising in retail media, for instance, which is also very strong on data? So it's so hard to tell. They could win every bank in the world and also digital bank, and then it's gigantic, enormous. But they could also suddenly find themselves having a secondary product compared to other advertising opportunities for customers. So we'll just have to take it a day at a time,
Yeah.
or
Uh,
maybe a
uh,
week at a time.
and Mads, I was thinking, since you're already sharing your screen, perhaps you'd want to take the whole HelloFresh earnings thing now, because Jakob actually managed to ask the question, even though he was thinking he wasn't joining. So we have it prepared, and I think Mads has something to show you.
Yeah, I'm not sure I
Oh,
prepare that much on HelloFresh, but
oh, okay.
I'll just take out the chart here on HelloFresh. So um, HelloFresh is a meal kit business, and and they did extremely well during the corona virus, because people and they were one of the e-commerce sectors that did the best during the coronavirus, and they 4x'd their revenues in a couple of years, and then it stopped, and they see a slowdown right now on it. They've bought Factor in the US, which is a ready-to-heat company. And Factor is growing at about 50% and is around 20%, 19, I think, of the company now, and is going to grow 50% next year. And that's going to be about all the growth that there will be from for HelloFresh Group. So the market, if you listen to why HelloFresh Group has gone down a lot, here is the share price. Um, then the market will say that meal kits are dead. That this was a flaw, and that's because growth is not there anymore. If you take the long-term growth has been 30% on meal kits, my bet is it's going to return to the normal, because the competition for meal kits are the supermarkets. The alternative is that we go and buy the groceries at the supermarket, and that's inconvenient. So I don't think that people will do that eventually in the long term. I think more and more will pivot to meal kits or ready to heat. So um, if you look at their price right now, then they say they're going to have a 10% EBITDA margin when they are mature. And right now they are trading at EV to sales of 0.2. So if you that means that the EV to EBITDA margin will be around 2 when they are when they get to that point. And that's insanely cheap. Yeah. So what is being a drag on the on the EBITDA right now is that they are investing a lot. They've been building out modern infrastructure facilities in UK and in Austria, Germany, and they've been ramping up production capacity in their factory ready to heat production in the States, achieving this 50% growth that they're getting, and they are ramping out ready to heat in Europe as well, various location in the Benelux and other places in Europe. So they're really investing a lot, and they've actually been buying back shares as well. So they've not been lending money or anything. They've been funding this growth themselves. So, but again, it's like Amazon. When the shit hits a fan, when markets go down, people want bottom line. So a company like Amazon investing in logistics and stuff like that, it's just so dang unattractive to investors in times like these. But it's also historically been companies that has been able to build out scale in their network, in their distribution network, that can achieve the lowest prices for consumers. And now they're a direct-to-consumer company with logistics facilities. So that means they're driving a van to people's homes, and you can get meal kits, you can get ready to heat. You can also get pet food now. And in the States, they have you can get steaks and you can get seafood. So they are direct to consumer company competing with the groceries that you have around, and they have a more effective value chain. And then you have automated deliveries coming up. So right now their competitor is the supermarkets, and they have better margins than the supermarkets, and that's something that might surprise you. But a meal kit company, when tomatoes are expensive in Europe, they don't serve you tomatoes. They serve you spaghetti bolognese, where you have canned tomatoes. But a supermarket, they have to have tomatoes, fresh tomatoes every day. Otherwise, customers will stop coming in the supermarket. And the supermarket has a lot of waste because the supermarket can't predict what customers want to eat. But HelloFresh knows what we're going to eat because they have data on you. So they know that when you put spaghetti bolognese on it, Jesper will order it every time because he loves spaghetti bolognese. And so thus they have a more precise, a more flexible value chain, and that creates a higher margin. So they are a better margin business than the supermarkets that they are competing with, and they are going to be delivering a higher service level. And right now it's balancing, and it's really balancing because people are willing to start their car, drive to the supermarket, and go find the tomatoes themselves. But I don't think that will last. It doesn't for me. I hate going to the supermarket and finding tomatoes. So it's going to break, and scale is going to come to the other value chain. So I think it's maybe one of the investment opportunities of a lifetime to be able to buy these direct to consumer businesses right now. And the market just hates it because it's low margin. But I'll tell you a funny story from ancient times. So if you go back to year 2000, and you ask any professional investor which is the better pick, Amazon or eBay, every professional investor would say eBay, no doubt about it. And you know why? It's because eBay was a low margin business. No, high margin business. Low capex, high margin. That's what we want as investors. But Amazon just rolled them over because they were able to enjoy customers by delivering everything. And I think it's the same opportunity here.
Yeah. And I mean, so HelloFresh is simply just not, they don't care about this trend about optimizing for profits right now, just as Amazon didn't back 20 years ago. And look at where they are today. But of course,
Yeah,
it's a tough choice. I mean, you're definitely going against the grain there. But either way, what I'm hearing you saying is that sort of the market is completely discounting the meal kit business, but not the ready to heat one. And you believe that the ready to heat one is great, but that the sort of meal kit business is probably also great in the longer term.
yeah, and also just this concept of direct to consumer. You're the guy having the van arriving at the customer's front door, and you can sell whatever you want to. So meal kits is just is just the enabler of that, taking the cost of having the van there, and then you can sell soy milk or pet food or beers or whatever you want to. So you could see it as a logistics platform for almost anything in the future.
We have a final question here for the night, I think. It's from Sen, and he asks if we still find the semiconductor giants attractive at the price they are right now, TSMC, Broadcom, etc.
Yeah, there's been a run up in the big tech stocks. They've been quite popular. We pointed at Broadcom in the autumn, Qualcomm as well. TSMC, we've had that as well, and now they've run up quite a lot, like I think 50% for Broadcom and TSMC. So it's getting a little bit less sort of obvious, and you see some drawdowns in some of those stocks. You've seen GitLabs, you've seen Snowflake tumbling, Sentinel-1, Palo Alto Networks. Some of the elite tech stocks has started to tumble over, and we're buying in those stocks, and we're not chasing the big chip stocks right here. You're going to see the footage from the presentations in Børsen are going to be available on our YouTube channel. So do subscribe to that. There's also a video about C-Limited earnings in there, about the Q3 earnings, where I do a deep dive on how to look at that. And but one of the things that I talked about in one of my presentations was the Nifty 50 stocks, and they were highly priced in 1973. The price was spot on. It was correct. If you see what returns they gave for the next 20, 26, 28 years, the market nailed the price, and yet they fell a lot in the years from 73 to 75 because market lost confidence in them. And that's the risk you take when you have a name that's run up a lot in the short run, that if market is not going to continuously believe that this stock is just a pure gold for the next 10 years, then you're going to see some corrections. So we'd rather not chase any of those at the moment, and then just enjoy buying them when they fall, and then some of them will remain small positions for maybe a year or two, but then they will come down to us again, I think, most of them. But yeah, we'll have a small position in the ones that just keeps rolling. But it's like threading a needle, just to pick out the ones that will just keep going like that.
It obviously also depends on your time horizon, right? Because I mean, buying Broadcom or Nvidia right now, I mean, they're definitely expensive. There's no way around it. It's just I thought maybe, Nvidia would stop running last year, like a whole year ago, and it just didn't stop. So there's no telling. But they're definitely great stocks. I mean, I bought Broadcom a few years ago, and I have had TSMC for a little while longer than that. And I mean, I'm not selling. I'm staying invested, raking in a dividend as well while I hold on. But I think I bought TSMC at a 10 PE, and now it's at like 24. So a lot of things have happened in a very short amount of time, and that's always, a reason for caution. So yeah, maybe look at other areas of the chip sector right now, and don't just jump on the giant obvious ones. But if you're in it for the long run, it probably doesn't matter, because I mean, semiconductors are, in my opinion, sort of like the new oil. It's a resource that we just can't get around, and it's only going to grow in the long term.
One stock you could look at if you like Broadcom and Marvell, that's Tower Semi. which is the company producing the photo optic chips, amongst others, that they are designing. Broadcom and Marvell for infrastructure in the data centers. So they have a great business doing that amongst other types of power and photonics chips.
Yeah,
So
and Tower is down quite significantly over the short term, right?
yeah, it's cheap. They were being acquired by Intel, and then that deal was, I think it was the Chinese that made
Yeah,
it impossible, and
regulatory
then it
approval.
just stumbled. It made investors
Yeah,
disappointed. So that's maybe a more under the radar a bet on the same thing. It's a stock we are accumulating in our portfolios.
yeah. All right, guys. Time is 21. Thanks for all the questions and also for a great suggestion here at the end, which we'll probably try to incorporate in next time. Yeah, we'll. I think that's it, right, Mads?
Yeah,
And
yeah, great pleasure as always, Jesper.
definitely. And I hope you get
And in
some rest
two
and have
weeks
your voice
time,
back, voice back soon. So thank you guys, and hope you enjoyed. Always, let us know what we can improve for next time. Otherwise, have a good night.
bye guys.
Bye.